That was an amazing session. Thank you, Kathleen, Stephen, and David. Up next, we've got lessons from the wealth makers. And here to lead the discussion is Vance Barse, wealth strategist and founder, your dedicated fiduciary. And the speaker is BlackRock's head of iShares U.S. Wealth Advisory, Michael Lane. Let's give them a round of applause.
Hello and welcome to Lessons from the Wealth Makers. We're going to jump right in, but first, I have a question.
Uh-oh.
By quick show of hands, who here is attending their very first conference since around March of 2020? Anyone? That's what I thought.
Good portion of the room.
Samesies. How amazing is it to be back in person, together, unified under one roof, at a conference in Miami nonetheless? Like, this is truly amazing.
As evidenced by the fact that not all the rooms are full, I think people are really enjoying the fact that they're out of their house.
Yeah.
You understand.
We've had 2 very long years to think about what matters most in life, and I'm happy to report publicly for the first time right here that I am so happy to be back in person that I will never again complain about the Prius driver going the speed limit in the far left lane. It is never going to happen. So it's a big deal to be back. And I thought that there was no better way to celebrate than by meeting with Michael Lane, who happens to be with the biggest asset manager in the world based on assets, which of course is BlackRock. So Michael, at BlackRock, there are a wealth of topics that you could have chosen for today's session. Why lessons from the wealth makers? What does it mean? And what can the audience expect in the next 25 minutes?
Sure. So there are lots of different topics we can talk about. And I sat through briefly a few of the other speakers' sessions, and there seems to be some consistency of what people want to talk about with what's going on in the world, and we'll talk a little bit about that as well. But if you look back in 1999, I had this idea of going around and speaking with significant financial advisors that were in this nascent new part of the marketplace, which was this registered investment advisor business. And you look back in 1999, there were a handful of RIAs, and I went around and I interviewed them and wrote a book called Secrets of the Wealth Makers. And the idea was to communicate what they were doing that was different, how they were thinking about creating wealth for clients, how they were transitioning wealth for clients. And I actually hadn't pulled the book. I published it in 2000, so it's been a long time ago, and I figured, well, that's kind of interesting. Maybe we'll do a talk about some of the changes that have taken place since 99, 2000. Some things feel the same, like the last session versus 99, 2000. Sometimes I feel like there's some similarities there. And what's different? What's the same? How are advisors using different solutions these days? Particularly, we're at an ETF conference. We can talk about that. I do find it funny to look back, and I pulled the book off the shelf in my office to see, who did I even interview? It was like so long ago. You forget who you interviewed for that book. And a lot of them are like now are legends. It's the Harold Ivinskys and Len Reinhardts and John Bowen, Lynn Hopewell, Glenn Kaus. These are early movers in our business that 22 years ago, it was interesting to interview them and see how things have changed. What's also interesting is if you look back when I first wrote that, you think about 99, 2000. ETFs came out in 93, and there was no money in them yet. 99, there was like maybe $1 billion or $2 billion. Like it was just a very nascent business. None of the advisors I spoke with, I was like, how many talked about ETFs back then? None. Nobody was talking about ETFs. It didn't exist as a business, basically. The advisors weren't using them. And now we look at where we are today. I mean, just iShares alone, the business I represent and oversee, is now almost $2 trillion with financial advisors. So that's just our business. Overall, it's close to $3 trillion of advisor-used assets in ETFs. So it's changed dramatically. The business has changed dramatically. The pricing has changed dramatically. The way they build portfolios, the way advisors build portfolios has changed dramatically. And part of that is because of the technology innovations, the efficiencies, the move to no transaction fees. Like everything has really compounded this movement. And so that's a long answer to a short question, which is why are we talking about this? I thought it might be interesting for people in the crowd, a mix of people in the industry, a mix of advisors, of what are the best and brightest financial advisors doing today and how are they using ETFs?
Wonderful. So how we serve clients today has evolved over time. Clients have access to much more information. They are asking questions around things like inflation, geopolitical dynamics, sustainable ESG, and financial advisors are faced with the opportunities to understand how to better serve client needs. And why don't you share what ETF trends and themes you're seeing among top advisors that address these challenges, and most importantly, what that means for clients?
Yeah, and this is where there's a little bit of similarity if you look back to 99 when I was running these interviews with people versus today. Back then, everybody was asking, like, should I, invest in pet.com? Should I, if you put .com behind anything, it's sold like crazy. You could have business plans that basically were publicly traded companies with no substance. And so, now like our last talk, and probably if I were to add it up, it's probably 25 to 30% of the talks now are about digital assets. Back then it was anything with a .com, now it's a digital asset, it's a hot topic. So tons of conversations about that. I'm going to avoid that topic because there's a whole lot of people talking about that here. So we won't talk about that so much. But there's two different types of advisors that we all kind of fall into and that I speak to on a day-to-day basis. And there's those that outsource a lot of the investment management. They outsource it for, into model development to strategists. Some, outsource it to TAMPs. And that's a very, I think in some respect, freeing way that people are doing a lot more business today than back in 99, 2000. That was a very upstart business. You look back, John Bowen, one of the people I interviewed back then, was one of the first creators of one of the first TAMPs, which was Reinhard Werba Bowen, which became another name and then became Loring Ward and is now Buckingham. So that's gone through 4 iterations. And then when InvestNet came out, which we all know, I thought InvestNet, it was a TAMP of TAMPs. Now they call that a TAMP and everybody else is strategist, so the terminologies have changed. But you've got these outsourcing advisors. And if you look at during COVID and during March of 2020 and subsequent volatility, the happiness factor, the sort of the comfort factor of those advisors was so much higher, so much better than those that are like rep as PM or advisor as PM. It's much more stressful when you're the one making the decisions on this because emotion comes into play. And you hope that when you outsource it to a third party that there's no emotion. I'm sure there's still emotion in many of these other third parties that are doing it. But that's been a growing trend in the business. So if you bifurcate the advisor business into a very large portion are moving more and more to outsourcing and hiring someone else to manage their money, even advisors I never dreamed would do it. Some of the largest, most significant advisors in the country that manage tens of billions of dollars are outsourcing it. And so that's one segment of the market. We don't get a lot of questions about geopolitical and inflation and things like that in terms of how it should affect their portfolios because they've outsourced that part. They want to understand it to have a conversation with their client, but they don't necessarily want to or need to have the conversation to make a trade or to restructure a portfolio. So that's one segment. Not a lot to talk about with that segment because it's a very smooth business for them. They align the right client with the right portfolio. Then there's the more involved, we'll call it, advisors where they're doing some of this work themselves. And that's where we're seeing a lot more tactical moves over the last 3 months than you normally would see. In fact, even one wirehouse home office, which typically they make tactical moves, they might make 1 or 2 tactical moves, in a 6 to 8 month period. They made 5 in the first 2 months of the year. So people are definitely moving money around a lot more, and part of it is the geopolitical, part of it is the inflation issues. But inflation's an interesting thing. Somebody said something in a talk that government's spending is what creates inflation, and I have a little bit of a counter to that, which is I went. This is going to be a little bit of a tangent, but I went to get my Ford F-150 truck service. So you just recently...
Are you in Texas, by the way?
Well, I was just going to say, you just recently moved to Texas. Do you own a truck yet?
No.
Okay.
However, I am
Not
a former owner of a Ford F-150 that I got in West Virginia, separate story offline. Anyway.
Well, West Virginia, that makes sense. So in Texas, when I moved there in 2009, the first thing I did, of course, after I looked around and 80% of the vehicles driving around the streets were trucks, I was like, all right, I got to get a truck. So I bought a truck. So I went to get my 2021 truck serviced this weekend. And while I was getting it serviced, I decided to walk into the showroom and see what was new on the floor. This dealership usually has 500 cars and trucks, Ford dealership in Austin, Texas. 500 cars and trucks on the lot. They had 10 new cars. The 10 new cars that they had on the lot, how much do you think they were marking them up? Above sticker.
20%.
So the one I looked at was a Ford Bronco that was on the floor. It was $48,000 sticker, $78,000. $30,000 markup. So here's the even more interesting part. So my car gets its oil changed. I go to pick up the car in the service department. I open the car door, and on my seat is an offer for my car, for my truck. It's 1 year old, it has 10,000 miles on it, and the offer is the same I paid for it a year ago, because if I sell it to them, they're going to mark it up 10,000 above the new car sticker instead of 30,000, and they're going to sell a used truck for 10,000 over sticker that's got 10,000 miles on it. Government spending isn't causing that. That's a supply issue. And a lot of what we're seeing in inflation right now is supply issues, whether it's energy supply is a big issue, or food supply, or used car supply, new car supply. Like, that's what's driving a lot of this inflation. And that's a big topic of conversation that advisors want to have. So what do we see advisors doing? It's a dilemma. Commodities, I can't say commodities are a hedge for inflation, but commodities are a big part of why we have inflation this go around. Energy and food, as well as other commodities like cars and manufacturing and stuff. So there's like a lot of that right now. So we're seeing a lot of advisors that are taking ownership of their portfolios, doing a couple of things. We see a lot more commodity exposure. We see people using ComT a lot more because of the commodity exposure to that. And in the midst of a big wave of advisors and endowments, foundations, institutions, some governments moving out of traditional energy companies, we see a big move going back now. We even see activists that are saying, you know what, we probably need to increase production. The problem with that, and this is why this isn't going to be a transitory inflation period, the problem is we're now asking traditional energy companies, live in Texas, so I talk about this a lot and I hear about this a lot from my Texas oil and gas friends. It takes 3 years to increase production to any substantive improvement. So supply is going to be what it is. Demand is going to continue to increase. There's not an alternative that's efficient and reliable, and therefore we're going to see a big shift, or we're going to see a big shift in terms of people are demanding more traditional energy company fossil fuels, which means the prices will remain high because supply is going to stay where it is. Demand is going to continue to increase. And so this is going to be a long-term problem. So we have people buying commodities. We see people barbelling traditional energy with clean energy. I know I did it myself, at the full disclosure. I mean, I bought IYE and iClean. One's traditional energy, one's clean energy, because clean energy is going to be more of an issue for Europe, and traditional energy is going to be more of an issue for the US. And so those are going to be barbelling effects. So we see advisors doing it. I did it because I saw a lot of advisors doing it. And then we've got this other issue with increasing yields. What do I do in my fixed income portfolio? And so a lot of the advisors that I'm talking to right now have been paring back for a while, duration, buying tips as well, but buying short tips, buying things like STIP, because at the front end of the curve, where 175 basis point increase in yield in the 2-year, that's probably a good time to be getting into those types of front end of the curve tips, avoiding maybe the longer duration in case there's an additional rate increases, yield increases, that you're going to get hurt on the duration side, might offset the inflation adjustment. So those are the things, the conversations are taking place, and those are the actions, the behaviors we see people taking.
Are you saying that I should buy a Ford in Texas? Do you want to sell me your truck?
See, that was my answer, is like, if I sell you my truck, I got nothing to drive. So like, that doesn't do me any
You
good.
can just Uber it everywhere. For those that don't know, one of the pandemic-related decisions that my wife made on behalf of the family was leaving my home sweet home, beautiful sunny San Diego, full-time anyway, and purchasing a house the northern Dallas area so that we could be closer to family while everything was shut down. As long as you're not with the Franchise Tax Board, I spend a week a month in San Diego, a week a month in Dallas, and the other 2 weeks a month I'm around visiting clients by plane.
Be honest, 0 state income tax versus 13.
So we have some questions.
Well, let me ask you a question.
Sure.
So the theme of the talk is lessons from wealth makers, and I did the book. You're a wealth maker. Let's call it 50% of the people in the audience are from our industry, 50% are other financial advisors. How are you using ETFs in your practice right now? And what's different about what you're doing today than maybe 9 years ago, 10 years ago, what you saw in the business as well?
Oh, that's a great question. So what's really interesting is that I come from the hedge fund world. I spent 10 years of my life traveling the country full-time, consulting private wealth advisors at wirehouses, independents, RIAs, and family offices on how to use big-name asset managers like Paulson, SAC, Brevin Howard, Citadel, Winton, QIM, you name it. And I find it so inherently ironic that I'm here speaking at an ETF conference.
Feels like a hedge fund conference.
Wow, have the times changed, right? But to answer the question, I'm a data-driven person. And many of the families that come to us for, our role as serving as their financial steward have had legacy assets like mutual funds, for example. So when the assets arrive, especially in non-qualified accounts, one of the very first things that we do after looking at the tax returns and the estate planning documents is open up the hood on the non-qualified portfolio. And if I can see that there are expensive, very tax inefficient investment vehicles, and I'm not knocking mutual funds at all. Let me make sure that I'm very clear about that. But if I can open up the hood on mutual fund A that costs, 79 basis points and has 85% in equities and the rest in fixed income, and I can go over here to option B that's an ETF with virtually the same stuff, and this is much cheaper and is much more tax efficient, it's my job to do what is in the best interest of the clients that are served by my firm, and that means that we have to transition from expensive, tax inefficient to much lower cost and tax efficient. How do we do that? We have a software that converts the average cost basis, which is listed on the statement, to the tax lot specific cost bases that have been capital gains and dividend reinvestments over years. You have an advisor at two-name firm and you get mutual funds back in 1972 and you reinvest, year over year over year. You have all these different tax lots. Newsflash, this just in, we can go in there and we can sell those that are up, offset those with those that are down, and create liquidity to to reallocate to lower cost, more tax efficient vehicles. And
it's interesting. The tax efficient word I used a lot. I tend to use a different word now when I talk about ETFs versus mutual funds. I just use the term tax control. And that's really what it boils down to, is in the mutual fund structure, there's nothing wrong with the mutual fund structure. They're all 40 Act products. The difference is you have less tax control in a mutual fund because there's not the structure that enables to offset, to wash out the capital gain distributions that would otherwise be paid that you see in the mutual fund. So it's a less efficient structure that minimizes your tax control. So using the ETF structure gives you more control over the taxes, and that's become a huge difference of the largest and fastest growing advisors are so tax sensitive now. 20 years ago, it wasn't a big topic of conversation. I don't even think there was in the appendix, tax was even a word. It was like very little discussion about that. Today, that is a massive discussion, but what confuses me is even with that ability to control taxes more, what we see is so many financial advisors, not the really significant advisors, but we see it in certain pools. They'll sell out of mutual funds by the end of the year to avoid the distribution. They'll go into an ETF for 30 days, and then they go back right into the mutual fund again, and they're going to have to do it again next year. And it's a very inefficient way to manage a portfolio, but we see that. We'll see 40% of our flows in ETFs will come in the fourth quarter because so much money is moving out of mutual funds into ETFs, and then we usually have terrible first quarter flows because it moves right back into mutual funds. And then over the course of the year, like last year, we had net new business of 160 billion. So like it was a good year, but we see big redemptions early in the year when a lot of people go back into the inefficient structure again.
Well, they have to do something between golf games, right?
Well, I'm not saying that, but yeah, it is just interesting. So other things that we're seeing and hearing, I'm sure you're hearing about it too. Megatrends have become a very popular topic with advisors. I think sectors was always the biggest focus, and now megatrends gives you a little bit more maybe specificity within the sector. Like instead of just healthcare, maybe genomic research, or robotics, for prosthetics, and so you're able to do so many different little kind of splinters of sectors that I see a lot of people starting to use those. And then ESG is one of the hottest topics out there, for better or worse. Some people hate it, some people love it. But
I have not met anyone in between those two cohorts.
Yeah,
now you ask another thing, as a data-driven person, I like to look at active versus passive and what historical alpha has been brought, if any, in an active vehicle relative to passive. Largely, by the way, since the advent of what I like to call the new investing paradigm, which was started on March 9th of 2009. We've been in this QE-driven, momentum-driven, ZERP, TINA environment. And coming from the very active world of the hedge fund universe, you just let the data speak for itself. So I like to look at what markets there are, where in the world they are, and really what type of account we're talking about to determine then that which the portfolio calls for, which is in the best interest of the portfolio. And for me and our clients, that's where ETFs come in. Why don't we ask some questions?
Sure. Go ahead.
What is the biggest impact an ETF has had on the advisory market?
It's still an impact I see when you think about the frictions that exist still with mutual funds. It impacts the way that you manage money, because you have to trade off like the dilemma of how much transaction costs am I willing to absorb for a client versus a trade. And ETFs, because of what happened when Charles Schwab decided to go, commission-free, and then everybody followed, that's made a huge impact, I think, in reducing the frictions that you have to talk about with clients. And so you can focus on things other than the $5 trade, the $20 trade, the $40 trade. So I think that ETFs have enabled, recently, in the last few years, less friction discussions, which is a good thing. I also think that ETFs have allowed advisors to manage money differently because of the liquidity aspect of ETFs, both on the fixed income side as well as the equity side. That now what we see a lot of these significant advisors doing is using index portfolios for the vast majority of the assets, and then taking real active risk where there's real active risk. It used to be a lot of people would use sort of closet index active. They basically were an active index, charging a high fee, but really hugging their benchmark. And I don't see as much use of that anymore. I see a lot of traditional indexes and some caveats to those indexes in terms of using megatrends or ESG or whatever that may be. And then taking much more active risk in areas of alternative investments. Sort of, Harold Vensky talked about it in the book back in '99, which was core and explore. We still see that happening, but it's a different explore and kind of a different core. Way more index-oriented on the core and way more active risk, more concentrated portfolios for any type of satellite.
What's the one sector, industry, or asset class that advisors need to reevaluate most for the rest of 2022?
I'm not a forecaster, but the writing's on the wall, as I mentioned earlier, with energy. It was the top performing sector in 2021 after being the worst performing sector for 7 out of 8 years, I think, before that. I think that clean energy really was popular for a while, and then when the Build Back Better plan kind of disappeared from legislation, then the clean energy sort of took a hit. Now with what's happening around the world, clean energy, especially in Europe, is getting a lot more popular again, so we're starting to see more attention paid to there. So if I were from a sector investor, the things I'd be looking at, I'd be looking closely at energy. Some people would say, well, I already missed the run. Energy prices are, oil's $105, $106 a gallon, $106 a gallon, and the clean energy, ETFs have, appreciated again. I've missed it. But as I said earlier, there's no great alternative yet out there. Wind, solar, geothermal, those are just not affordable, efficient energy sources yet. So there's going to be a lot of growth still in that area. And traditional, it's going to take a long time to increase supply. So therefore, those prices aren't going back to 40 or 50 bucks probably anytime soon.
If they do, maybe I'll end up with a Prius.
Yeah. Well, no, if they go back to 40 to 50, then you can get.
Then I'll get 2 trucks.
You get a Ford truck. Yeah.
What's the name of the tax software you referenced to move specific lots from mutual funds to ETFs? It is Wealthscape, and to be clear, we conduct tax loss harvesting with tax lots in mutual funds, tax efficiently create liquidity, and then redeploy into lower cost, more tax efficient ETFs. And with that, our time is up. Thank you all very much for the opportunity to be here.